Imagine waking up one day and looking at your bank balance, maybe not with dread, but with this quiet satisfaction, knowing that your money isn't just sitting there, maybe losing value bit by bit, but it's actually out there, working, actively generating more wealth for you. What if you could, like, flip the script, you know? Flip the script on just saving and really make your finances this powerful engine for your future. Is that just, I don't know, a financial fantasy, or is it something real, something attainable for you? Welcome to the deep dive. Today we're plunging into something that, well, it touches every single one of us, but it often feels wrapped up in intimidating jargon, maybe complex strategies. We're talking investment types. You've given us some really fantastic source material just packed with insights, and our mission really is to unpack it all, cut through the noise, reveal the fascinating and often kind of surprising ways you can make your money, well, work for you. We're talking everything, from the stuff that seems mundane, the safe bets, all the way to the truly adventurous, like the wild frontiers of finance. And by the end of this deep dive, you should have a clearer picture, a more nuanced one. Not just what these investments are, but crucially, why they matter to your own financial journey, how they all fit together.
Yeah, and if we connect this to the bigger picture, think about it. We live in a world where economic forces are constantly shifting, right? Inflation can quietly just chip away at your purchasing power. Market cycles go up and down. It raises a really important question. How do you genuinely make your money work for you? Not just, safeguarding its value today, but actively growing its potential for tomorrow. It's not just about the numbers on a screen. It's about preserving the actual power of your money, what it can do for you.
Right. And critically, as we sort of navigate these waters, what are the hidden dangers, the subtle ones, often overlooked, and things that seem totally safe? And, conversely, what are the surprising opportunities, maybe the counterintuitive ones, lurking in what feels inherently risky? This deep dive, it's really designed to guide you through understanding each investment type's real risk profile, its potential for return, its ideal time horizon. Will help you think about how to maybe employ them together, like orchestrating a symphony of assets based on your unique goals, your personal risk tolerance, your specific circumstances. So let's peel back the layers. Let's uncover these crucial insights. Okay, let's unpack this first one, this foundational type of asset, cash and saving accounts. On the surface, they feel like the ultimate safe bet, don't they? Your money's right there, totally accessible, seems predictable. We're talking about your typical savings accounts, certificates of deposit CDs, people call them even just plain old bank deposits, or, cash under the mattress, although maybe not that. For a lot of people, this is the very first place they put their money. It's almost instinctive, isn't it? The first step. And the appeal is immediate. It makes sense. Your funds are often insured, FDIC in the US, or similar elsewhere. They're not jumping around wildly with the market. And you can pull them out whenever you need them, usually instantly.
And what's truly fascinating there, especially if you're someone who really prioritizes, immediate access and absolute capital preservation, is their inherent low risk and incredibly high liquidity. That's the key. You can get your funds easily, usually within a day, sometimes instantly, no penalties, no complex hoops to jump through. The return, it's often modest, but it's fixed. You know what you're getting from the start. And that gives this comforting sense of certainty, this predictability. It's exactly what makes them great for specific short-term things, like maybe you're saving for a down payment on a house in 6 months or a new car next year. They give you that rock-solid guarantee that the amount of money will be there when you need it, exactly as you expect. It's really the opposite of market speculation. It's all about certainty. Tone shifts, becomes more serious. But, and this is a big but, here's where it gets really interesting. And frankly, maybe a bit shocking for many people. The major drawback, the one that often goes unnoticed by, the casual saver, the return you get from cash and savings accounts.
It's often, typically lower than the rate of inflation.
Oh, wow. Okay.
Yeah, so think about what that means. Paradoxically, while the number in your account might stay the same, or maybe tick up just a tiny bit, the purchasing power of your money is actually going down, diminishing over time.
So it's like melting away.
Exactly. It's like having your money slowly melt away, losing its real value without any big warning signs. Consider this, right? If your savings account gives you, say, 1% interest for the year, but inflation is running at 3%, well, that same amount of money you have today, next year, it'll effectively buy 2% less stuff. Less goods, less services.
Ouch.
Yeah. Even though the number looks constant, its real value, its ability to actually acquire things, it just steadily erodes. This subtle loss, often unnoticed, that's the hidden cost, the cost of prioritizing that extreme safety. Inflation becomes this silent, invisible thief of your wealth. It's not just that you missed out on growth. It's an active, even if slow, degradation of your financial standing.
Thoughtful. Okay, so what does this mean practically? For someone listening, thinking about their strategy, our sources are pretty clear, right? Cash savings accounts. They're perfect for an emergency fund. Like 3 to 6 months of living expenses, that's crucial. It stops you going into debt if something unexpected happens. Job loss, medical stuff, car repairs, you know the drill. And for beginners, people just starting to learn about managing their money, parking some cash here while they educate themselves, that can provide a kind of psychological safety net. Gives you security, no doubt, but it definitely comes at a cost, the cost of lost purchasing power. So it's foundational. You need it. But it's definitely not where you want the bulk of your long-term wealth sitting if your main goal is like substantial growth and keeping its value over time. Transitioning. Okay, so from the seemingly static world of cash, let's pivot. Let's talk about something a bit more tangible, maybe more romanticized. Gold and precious metals. Why is it, do you think, that people throughout history, and especially when things get scary, seem to flock to gold? It's always called the ultimate safe haven, isn't it? You always see headlines, right? Gold prices surge when there's geopolitical tension, economic uncertainty, even just general global anxiety. It seems to have this almost, I don't know, mythical appeal, like a deep-seated human trust in its inherent value that goes beyond borders or politics.
Hmm. That's a really great observation. And the appeal of gold, it really stems from a few core things. Its value tends to increase with inflation and, importantly, currency devaluation. Think about when central banks start, quantitative easing, or governments print more fiat money, or just when economic stability seems shaky. The purchasing power of paper money often declines in those scenarios, but gold often retains its value or even increases it. Why? Because its supply is finite. You have to dig it out of the ground, right? It's a slow process. And it's universally recognized as valuable across cultures throughout history. So it's seen as this stable store of wealth when everything else feels uncertain. A tangible asset that doesn't depend on the promises of any single government or company.
Like a hedge.
Yes, exactly. For many, it's the ultimate hedge against what they see as maybe irresponsible monetary policy or big systemic financial risks. Plus, it can be stored. Physically, sure, in vaults. But more practically for most people today, through digital certificates or even exchange-traded funds, ETFs, that represent ownership of physical gold. You don't have to actually hold the bars. That accessibility makes it even more useful as a strategic tool for diversification. Pensive, however. And this raises a really crucial point for anyone listening carefully. While gold is great as a store of value, it doesn't actually generate income.
Right. No dividends or rent checks.
Precisely. Unlike stocks, where you might get dividends from company profits or real estate, which can give you rental income, gold just sits there. It preserves its value, hopefully, but it doesn't actively produce more wealth for you through regular payouts. Any return you get comes purely from capital appreciation, basically, when its market price goes up. Also, while it might be stable long-term, its price can fluctuate, sometimes significantly in the short term. It's less predictable day-to-day than people might think. We've definitely seen times where gold has soared dramatically, right? Only to pull back sharply soon after.
Yeah, absolutely.
So while it's a robust long-term store of value and a hedge against certain economic problems, don't expect a smooth, consistent ride upwards month after month. It's really about capital preservation and protection, much more than consistent income generation.
That's a really crucial distinction and probably a common misconception, like you said. Lots of people probably think gold is some kind of get-rich-quick thing. But based on our sources, it sounds like gold holdings should be part of your portfolio, not the whole thing. It's mainly about diversification, right? Like a strategic insurance policy for your wealth, a way to maybe mitigate specific risks like inflation or currency collapse, rather than the main engine designed to make you wealthy super fast.
Exactly. It adds a layer of stability, resilience to a well-rounded strategy. Its inclusion really speaks to thoughtful asset allocation.
More energetic. Okay, now let's shift gears. Let's move into the realm of potentially, well, explosive growth. The engine room, you might say, of modern investing. Stocks. This is where you literally buy a piece of a company. You become a fractional owner, even if it's tiny. When you buy a share, you get a claim on its future earnings, its assets, sometimes even voting rights. The concept behind it is straightforward, but it's really powerful. As the company grows, innovates, makes profits, your share hopefully grows in value too. If Apple keeps selling more iPhones or Amazon expands its cloud services and delivery network, the value of their stock often rises. And so does the value of your investment. It's like you're directly participating in the success of these businesses that drive our economy, building enthusiasm. And this is where, historically, you find the highest potential returns over the long term. Stocks have generally outperformed most other asset classes over decades, and the barriers to entry, they're surprisingly low now. You can start with really small amounts. Thanks to things like fractional shares offered by a lot of modern brokerages, you can buy just a piece of even a really expensive stock like Google or Tesla, and you benefit in potentially two ways. Profits from the company's earnings, which might be paid out as dividends, and an increase in the value of your shares as the company itself grows and becomes more valuable in the market's eyes. That combination, income and capital appreciation, that's a major draw for people looking for significant wealth creation.
Firm advisory tone, intensity rising. But, and this is absolutely crucial advice for anyone listening, it's fascinating but vital. Stocks, while they offer that huge potential, they absolutely come with high risk.
Right, that volatility.
Exactly. Their prices are notoriously volatile, they fluctuate constantly, and it's not just driven by company performance or economic news. It's market sentiment, geopolitical events, even just, herd mentality sometimes. So this raises a really important, very personal question for you. Are you genuinely prepared for that level of movement, that short-term uncertainty in your capital?
It can be stressful.
It really can. Investing in stocks isn't like buying a lottery ticket. It's not a passive gamble. It demands considerable knowledge, a well-defined strategy, and often continuous monitoring and, frankly, diligent study. This is a key distinction many people overlook. They get lured by headlines about overnight millionaires, maybe. But without truly understanding things like financial statements, industry trends, macroeconomic factors, the psychology of the market, you're not really investing. You're basically speculating. And the market, well, it consistently rewards informed risk takers over the long run, not blind speculators. Understanding why a stock moves, not just that it moved, that's paramount.
Highly energetic, shifting focus. And on that vital point, needing real knowledge, needing a solid strategy to navigate these complex markets, I want to highlight something really incredible. A resource for our listeners, the Shark Trading Channel. It offers highly specialized and, frankly, professional-level content in trading and investment. It features 7 professional courses. Get this. 2 of them are for experts, and apparently they've generated significant buzz by revealing some major secrets behind the financial markets. Plus, there are 4 professional best-selling books available through them. Honestly, this channel sounds like a huge asset. The kind of information it provides, it often sells for very, very high prices elsewhere. We'll put the link to the channel in the description. If you're serious about learning, it sounds like a potential game changer. Transitioning, grounding the topic. Okay, so from the digital world of stocks, often quite abstract, let's pivot back to something you can literally touch, something you can feel, maybe even live in, real estate. This has been a classic, enduring investment for ages, hasn't it? Often seen as a cornerstone of wealth for so many families and individuals. Unlike that intangible share in a company, real estate gives you a concrete physical asset, a building, a piece of land. You can see it, walk on it, derive direct utility from it, whether you live in it, work from it, or lease it out to someone else. And there are a few different ways to get into real estate investing. You can obviously buy a property directly, maybe a house, an apartment building, rent it out, become a landlord, collect that income stream. Or you could buy raw land, hold on to it, hoping its value goes up over time as, cities expand or areas develop. Or for those who want the benefits of real estate, but maybe not the hassle of direct management, dealing with tenants and toilets, you can invest through real estate investment trusts, REITs, they're called.
REITs are interesting.
Yeah, they're basically companies that own, operate, or finance income-producing real estate. All sorts of stuff, apartments, malls, warehouses, data centers. And the key thing is, REITs trade on major stock exchanges, just like regular stocks, which makes real estate investing much more accessible, even if you don't have huge amounts of capital, and it gives you more liquidity than owning a building directly.
Absolutely. And the advantages of real estate, whether direct or through REITs, they're compelling. It can provide that stable income through rent, a consistent cash flow, which can be great for supplementing earnings or funding retirement. Plus, the asset's value, the property itself, tends to increase steadily over time, especially in growing areas or desirable locations. That offers significant capital appreciation long-term, and crucially, it acts as a really strong hedge against inflation.
Ah, right, because rents tend to go up with inflation.
Exactly. As the cost of living rises, so does the cost of housing and rental income. So your real estate investment can often keep pace with, or even beat, rising prices. It protects your purchasing power. That tangibility, combined with the inflation protection, those are strong reasons for its enduring popularity. Shifting to challenges, more cautionary, however. If we connect this back to the bigger picture, especially for individual investors buying directly. Real estate inherently requires significant upfront capital. That's a big hurdle.
Yeah, the down payment alone can be huge.
Right. Buying a property outright or even just making that substantial down payment, it's a major financial commitment.
Yeah.
Often means taking out large loans, paying interest costs. It's also notoriously illiquid. You just can't sell a property as easily or quickly as you can sell stocks or bonds.
Takes months sometimes, doesn't it?
Weeks, months, easily. You've got real estate agents, legal fees, inspections, finding a willing buyer. It's a whole process. And don't forget the ongoing costs, often substantial ones. Maintenance, taxes.
Property taxes, insurance,
Yeah.
repairs.
Exactly. Property taxes, insurance premiums, routine repairs, maybe unexpected renovations, tenant management issues, potential vacancies when you don't have a renter. These are all recurring costs and responsibilities that can significantly eat into your returns. And they require active management. It's really far from being a truly passive income stream, which is how some people might initially imagine it.
That's a really critical point. The capital needed, the illiquidity, the ongoing effort. Lots of people are probably drawn to real estate but feel shut out by those barriers or maybe just put off by the landlord headaches. But as you touched on, if you don't have the cash for a whole building or you just want to avoid fixing leaky faucets, there are those modern alternatives like the digital real estate funds, the REITs we mentioned. They make this type of investment much more accessible for the average person. You can participate in large-scale, professionally managed real estate projects without needing millions up front or dealing with those late-night tenant calls. It's a way to potentially get the benefits of real estate, that income and appreciation, without all the traditional operational burdens.
Okay, shifting gears slightly again. Let's talk about bonds. Now, this is a completely different way of investing, isn't it? You're essentially lending money, not buying ownership.
That's right. Think of it like an IOU.
Yeah. When you buy a bond, you're not getting a piece of a company like with stocks. You're acting as a creditor. You're lending money either to a government, could be local, state, national, or to a corporation. Governments issue bonds to fund public projects like roads or schools. Corporations issue them to finance their business, maybe expand or refinance old debt. And in return for your loan, the issuer, the borrower, promises to pay you fixed interest over a set period of time.
That's the coupon rate.
Right. The coupon rate, usually paid, what, twice a year?
Typically semi-annually, yes. And then at the end of the bond's term, the maturity date, you get your original money back, your principal. So it makes them fundamentally different from stocks. They're debt, not equity. And their appeal really lies in offering that predictable income stream. That's a big draw for certain investors seeking stability.
Exactly. Their main benefit is offering that steady, regular income. You know precisely what interest payments you'll receive and when you'll receive them. That makes financial planning much more straightforward, much more reliable, especially if you're in or nearing retirement. That predictability is golden. And government bonds, particularly those issued by really stable economies like U.S. Treasuries, they're considered among the lowest risk investments you can find. The chance of a stable government defaulting on its debt is extremely low, so they become a cornerstone for conservative portfolios, providing that solid, predictable foundation. Explaining the trade-off. The main trade-off here, though, is pretty clear. You generally get a relatively low return compared to stocks. Bonds are safer, sure, but they rarely offer that explosive growth potential you might see in equities. But here's something less intuitive, something called interest rate risk.
Yeah. How does that work again?
Well, the value of the bond itself, the price someone would pay for it on the open market, can actually decrease if broader market interest rates rise after you bought it. Imagine you bought a bond today that promises a 2% annual return. Okay. Now, what if, shortly after, the central bank raises interest rates and new bonds start being issued paying 4%?
Your 2% bond doesn't look so good anymore.
Exactly. Your older 2% bond instantly becomes less appealing to new buyers. So if you needed to sell your bond before it reached its maturity date, you'd likely have to sell it at a discount. You'd have to lower the price so that its effective yield matches the new higher market rates, which means you could actually lose some of your principal value if you sell early. That's a really important nuance for bond investors to understand.
Okay, so considering that balanced stability, predictable income, but lower returns, and that interest rate risk, who are bonds really best for? Practically speaking, our sources suggest they're particularly suitable for people maybe nearing retirement, or those who just really prioritize capital preservation and consistent income over chasing higher, riskier returns.
That's right. If you're going to rely on your investments for income during retirement, those predictable interest payments from bonds,
Hmm.
they can be incredibly valuable for covering your living expenses. They provide that reliable income stream. And they offer a crucial buffer against the kind of market swings that might hit your stock holdings hard. It's really about preserving your capital and generating consistent, even if modest, income. So they often become a bigger part of your portfolio as you get closer to retirement age.
Shifting focus. Now, for those folks who want diversification, maybe sophisticated diversification, but they don't want to become like a full-time market analyst,
Yeah.
investment funds, specifically things like exchange-traded funds, ETFs, and mutual funds, these are incredibly powerful tools.
Yeah, they really democratize investing in many ways.
They do. They make it much more accessible, less daunting for a lot of people. They take a lot of the guesswork out of picking individual assets. So how do they work?
Yeah.
It's quite neat, really. They're basically a big basket, a professionally managed collection of various assets, could in stocks, bonds, other securities, all bundled together and bought and managed as a single product. So instead of you researching and buying, say, 50 different stocks, you just buy one share of a fund. And that fund already holds those 50 stocks, or maybe hundreds, even thousands.
Mhm.
And there's a professional fund manager or a team making investment decisions, managing the strategy, rebalancing things for you. So you're not picking the individual assets yourself. You're basically leveraging their expertise and research, which, let's face it, is a huge time saver and gives a lot of peace of mind.
Oh, absolutely. The immediate benefit is automatic diversification. That massively reduces risk compared to just buying one or two single stocks. If you own just one stock and that company hits trouble, your whole investment is at risk, right? But if you own a fund holding hundreds of stocks, one company having a bad year, it'll have a minimal, almost negligible impact on your overall investment.
Spreads the risk out.
Precisely. And they allow for remarkably easy entry. You can start with relatively small amounts, often just a few $100s. Makes them accessible to almost anyone. And they're absolutely perfect for people who maybe lack the time or the interest or just the specialized expertise to manage their own really diverse portfolio. You can essentially, set it and forget it to a much larger extent, trusting the professionals are handling the day-to-day. And ETFs specifically have some extra advantages. They trade throughout the day on exchanges, just like stocks. And they often boast lower expense ratios, lower fees compared to many traditional mutual funds, which means more of your money stays invested, working for you, addressing drawbacks. Now, while they are super convenient and beneficial, there are things to consider. Funds do come with management fees, the expense ratio we mentioned. And although they might seem small, maybe 0.1%, 0.5% a year, those fees accumulate significantly over decades. They compound, just like returns do, and they definitely eat into your long-term results.
A subtle cost.
A subtle but real cost, yes. Also, because funds are generally diversified across the board, their performance tends to be closely tied to the overall market they track. So while you benefit from broad market growth, you're unlikely to significantly outperform the market. But the flip side is you also won't suffer from picking one single catastrophic bad stock. We often call this achieving market returns. You basically get what the overall market delivers minus those fees. And honestly, for many, many investors, achieving average market returns consistently is perfectly fine. In fact, it's often preferable to trying and often failing to beat the market.
Yeah, that makes sense. And can you give us an example, a well-known fund maybe?
Sure.
A really famous example, one often recommended by financial advisors, is the VOO fund. VOO, it's an exchange-traded fund, an ETF, that tracks the S&P 500 index.
Right, the 500 largest U.S. companies.
Exactly. So by investing in just VOO, you instantly get exposure to 500 of the biggest U.S. companies. We're talking Apple, Microsoft, Amazon, Google, all the household names. It's a simple, usually very low-cost way to get broad market exposure and benefit from the collective growth of the overall American economy, all in one single investment. Super convenient, urgent advisory tone for CTA. Now, speaking of platforms and making investments, given the, frankly, alarming proliferation of scam trading platforms out there, ones that are really far removed from genuine trading and investment, we wanted to highlight something important. We've looked into a safe and global platform for trading and investment. It's widely considered among the best investment platforms available. It allows you to trade in the stock market, gold, currency pairs, that's Forex, and many other markets too. Importantly, users report it's incredibly fast for withdrawals and deposits, and get this, they apparently offer a 50% bonus on your first deposit. We've put the link for this specific platform below in the description for you to check out if you're looking for a reliable option. Please do your own research too, of course.
Reinforcing the need for education. And just to build on that point about reliable platforms and crucially knowing what you're doing, I also want to draw your attention to a professional course we found. It's designed for learning trading and investment from scratch, but in a genuinely professional manner. The link for that is also available in the description below the video. Equipping yourself with the right knowledge before you start, especially with complex things like trading, it's absolutely vital. It helps you tell real opportunities from potential pitfalls.
Intrigued, slightly adventurous tone. Okay, now, for the truly adventurous among us, or maybe just extremely curious, we dive into what's broadly called alternative investments. This category is a real grab bag, isn't it? A diverse, often unconventional mix of assets that exist totally outside the traditional world of stocks, bonds, mainstream real estate.
That's where things get interesting.
Definitely. It's where financial innovation meets maybe bold speculation, and sometimes where you find genuinely bizarre opportunities, listing examples with a hint of wonder. So what are we talking about? Well, it includes everything from the notoriously volatile, rapidly evolving world of cryptocurrencies, Bitcoin, Ethereum, all the others that have just exploded onto the scene, to more established but still distinct assets like commodities. Think oil, natural gas, other precious metals like silver or platinum, maybe agricultural products like coffee beans, sugar, livestock. But it doesn't stop there. We're also talking fine art. Rare collectibles like vintage cars, luxury watches, unique jewelry, even rare wines.
Things you wouldn't normally think of as investment.
Exactly. And get this, our sources even mention poultry.
Slight chuckle. Poultry.
Yes. Apparently, investing in highly specialized breeds of chickens for their unique eggs or meat, or even just for breeding purposes in niche agricultural markets, that's a real and sometimes lucrative alternative investment in certain parts of the world. It just highlights how incredibly diverse and sometimes unexpected investment opportunities can be. Way beyond Wall Street.
Acknowledging appeal, slight enthusiasm. And the undeniable allure here, the reason people are drawn to these things, it's the potential for exceptionally high profits. If, and it's a big if, you truly understand and can navigate these specific, often opaque markets, there's the possibility of achieving massive returns, even life-altering returns, sometimes in a very short period. And that raises that important question that hooks so many people. Who wouldn't want that kind of rapid, significant wealth creation?
We've all heard the stories, right? Early Bitcoin investors, lucky art collectors.
Exactly. Those legendary stories of becoming millionaires overnight or making fortunes on undervalued artists, they capture the imagination. Plus, these markets can sometimes be less correlated with traditional stock and bond markets. They might move independently, which means they could offer genuine diversification benefits, maybe holding up when traditional markets fall. So for those with deep specialized knowledge, maybe unique access, and an incredibly high tolerance for risk, the rewards can be truly staggering, far beyond what traditional investments might offer in the same time frame. Tone shift dramatically somber, cautionary slower pace. But, and here is where it gets really interesting, and you absolutely need to pay very, very close attention. The risks are equally extreme, if not more so.
Right. The flip side of high reward.
Absolutely. These alternative markets, they are highly unstable, notoriously opaque, meaning hard to get clear information, and often wildly unpredictable. Cryptocurrencies, for example, they can swing 20%, 30%, even more in a single day, wiping out huge amounts of capital in the blink of an eye.
Seen that happen many times.
Fine art markets, highly subjective. Illiquid, hard to sell quickly. Depends heavily on trends, expert opinions. The whims of a few wealthy collectors, they demand highly specialized knowledge. This is emphatically not an area for casual speculation, not for dabbling based on something you read on social media. You can lose a lot very, very quickly. If you're not an expert who intimately understands the underlying mechanics, the supply-demand dynamics, the specific ecosystem of that particular alternative asset, these are definitely not set-it-and-forget-it investments. Not even close. They require constant vigilance, deep independent research, and a profound understanding of very specific market dynamics that often defy traditional economic models. It truly is the wild frontier of investing. And it can lead to incredible wealth or, well, indeed, an abyss of loss.
Thoughtful, connecting. Okay, so after exploring all these incredibly diverse, really distinct investment types from the, seemingly safe but maybe subtly eroding cash all the way to those exhilarating but definitely perilous alternative assets, the biggest question on probably every listener's mind right now is, okay, where do I start?
The million-dollar question.
Exactly. And the answer, as our sources just clearly and consistently outline, it depends entirely on your unique situation. There's no magic bullet here. No one-size-fits-all solution in this complex world of investing. Understanding your personal circumstances, that's the foundational, the absolutely indispensable first step in crafting your own unique investment blueprint. Your age, your income now, your goals for the future, your existing debts or obligations, and maybe most importantly, your psychological comfort with risk and your financial ability to handle potential losses.
Yeah, your risk tolerance.
Right. All these factors, they combine to define your personal investment profile. Advisory, clear. So let's try and break this down by profile based on the sources. If you're just starting out, maybe you have limited funds right now, the advice seems really clear. Begin with ETFs, get that automatic, broad diversification. And, crucially, establish a dedicated saving account specifically for emergencies. Build that safety net first.
Non-negotiable, that emergency fund.
Totally. It gives you that peace of mind to handle unexpected stuff, job loss, medical bill, without having to sell your growth investments at potentially the worst time. And ETFs. They're a fantastic, usually low-cost way to just dip your toes into the stock market without needing to become an expert stock picker overnight. You get broad exposure, controlled risk, professional management, often with tiny fees. It's like the perfect training ground for a new investor.
Calm, strategic. Okay, now for those maybe a bit further along, you got a solid financial foundation, maybe more capital to invest beyond that emergency fund. The core recommendation here is profound diversification. And that's not just a buzzword, right? It means strategically spreading your investments across a variety of different asset classes. Thinking about a thoughtful mix. Stocks for growth potential, bonds for stability and income, maybe some gold for that inflation hedge, and various investment funds like ETFs for broad market exposure and professional oversight.
Like a balanced meal for your finances. Small chuckle. Exactly like that. A balanced meal. This multi-asset approach, it helps smooth out your returns over time. Because different asset classes tend to perform differently in various economic conditions. Stocks might boom when the economy's strong, but bonds or gold might offer more stability during a downturn, for instance. The whole goal is just avoiding putting all your eggs in one basket. Minimizing the damage if any single investment type has a really bad run.
Voice takes on a spark of excitement, but cautious. Now, what about the true adventurer? Someone with a really high-risk tolerance, maybe deep specialized knowledge in a certain area, and they're genuinely ready to take on significant risk for potentially massive, maybe even disproportionate reward.
High-stakes players. Yeah. For them, assets like digital currencies, cryptocurrencies, maybe high-growth technology stocks, certain niche commodities, those might really call to them. This is where you might chase those potentially explosive multi-bagger returns, seeking out disruptive technologies, new industries, volatile markets. And it's a huge but, remember what we said. This path demands intense ongoing study, almost an obsessive dedication to understanding those specific market dynamics, and a very, very strong stomach for extreme volatility. You must be prepared for the possibility of significant losses, maybe even total loss of that capital. So only invest money you can genuinely afford to lose in these areas.
Crucial point.
It's definitely not for the faint of heart, but for those who really master the intricacies, the rewards can be truly life-changing.
Measured, focusing on preservation. And then for those looking towards retirement, maybe already in their retirement years, the priority shifts, doesn't it? It becomes about stability and reliable income generation.
Preservation becomes key.
It's exactly capital preservation and predictable cash flow. The advice from our sources is pretty consistent. Focus on bonds for their consistent interest payouts, maybe income-generating real estate if managed well or through REITs, and a selection of stable dividend-paying stocks, companies with a long history of consistent returns rather than aggressive, high-flying growth stocks. At this stage of life, you're less focused on hitting home runs, more on getting reliable singles and doubles, financially speaking.
Consistent income to live on.
Precisely. You need reliable income streams that can comfortably support your lifestyle without exposing your accumulated nest egg to undue market risk. Real estate can provide rental income, bonds offer those fixed interest payments, dividend stocks deliver regular payouts. It all contributes to a more predictable and secure financial future.
A helpful reminder. And it's probably worth mentioning here, we've actually talked a lot about risk management, portfolio allocation, long-term planning in some of our previous deep dives. So if you want to explore more about how to strategically mitigate some of the specific risks we've talked about today, or how to build a really resilient portfolio, you might want to check out our earlier episode on, say, navigating market volatility, or the one called The Power of Diversification. Those deep dives will give you even more tools for your investment toolkit as it evolves.
Profound, challenging tone.
This whole discussion, it really brings us back to some fundamental, maybe even philosophical questions for every single investor listening. Given the just overwhelming amount of information out there, that constant fire hose of financial news, the pervasive lure of get-rich-quick schemes, how can you, the individual, truly tell the difference? How do you discern genuine, sustainable opportunity from dangerous, often deceptive speculation?
It's tough. There's so much noise.
It really is.
Yeah.
The financial landscape is just rife with promises that sound too good to be true. And often they are. Critical thinking, doing your own homework due diligence, and maintaining a healthy dose of skepticism. Those are your absolute best defenses. Understanding the underlying fundamental mechanics of why an investment might work, not just believing the flashy headlines or the social media hype. That's paramount.
Direct, thought-provoking. And finally, maybe think about this. What's the real cost, the hidden cost of playing it too safe, of just letting inflation quietly erode your hard-earned wealth year after year after year? And conversely, what's the ultimate danger of risking everything without truly understanding the complex game you're playing, without the knowledge, the strategy, the discipline?
Two sides of the same coin, really.
Exactly. These aren't just rhetorical questions, are they? They're critical, deeply personal questions for your entire investment journey. Is your comfort zone actually costing you purchasing power, silently but relentlessly? And on the other hand, is your desire for rapid gains maybe leading you down a path of recklessness, ignoring sound financial principles, finding that balance, that sweet spot between prudent, informed growth and irresponsible gambling? That's really the essence of smart, effective investing, isn't it? Warm, encouraging. Your curiosity, it genuinely fuels these deep dives. So if you have a specific topic you'd like us to explore in a future deep dive, something you're wondering about, maybe a financial challenge you're facing, please let us know in the comments below. We absolutely love hearing from you, and we really do try to shape these deep dives around what you're interested in. #tag outro. Yeah, reflective summarizing. Wow, what an incredible, really comprehensive journey through the world of investments today. We've peeled back quite a few layers, I think, to see that making your money truly work for you, it isn't about finding some single magic bullet, is it? Or just following the latest trend. Not at all. Instead, it's about understanding and then strategically using a diverse toolkit of financial instruments. Everything from that seemingly steady drip of savings all the way to the exhilarating, but perilous heights of those alternative investments. Each asset class, it has its own unique place, its distinct pros, its inherent cons. And the truly savvy, informed investor understands how to blend them, how to orchestrate them into a cohesive strategy that's right for them.
Yes. Authoritative, conclusive. Yeah, and the most powerful, the most enduring key takeaway from all the sources we looked at is unequivocally this: knowledge is your most powerful asset, far more valuable than any amount of initial capital, really. Understanding the intricate nuances of risk, potential return, and crucially, your own personal circumstances, your goals, your time horizon, your temperament, your risk tolerance. That's what truly empowers you to make informed, deliberate, and ultimately, hopefully, successful financial decisions. It's not about memorizing stock tickers or trying to time the market perfectly. It's about grasping the fundamental principles: how money truly grows, how it can be protected, and how it can be purposefully employed to serve your own long-term aspirations. Provocative closing thought, slight pause. So as you reflect on your own financial landscape, as you look at your current assets, your future ambitions, maybe consider this profound question: is your money truly working for you right now, diligently building your future wealth? Or are you still primarily working for your money?
Maybe caught in a cycle where your efforts just barely keep pace with inflation or economic forces. The choice and the immense potential for transformation, that's entirely yours to explore.
Warm, encouraging, energy rising. We've packed a huge amount of valuable insights into this deep dive, really tried to break it down. And to help you continue your learning journey, you'll find important links to all the sources and the recommended resources we discussed today right there in the description below. I highly, highly recommend you check them out. There's always so much more to discover. Increased energy for final CTA. So, if you found this deep dive helpful, if you enjoyed learning about how to potentially make your money work harder for you, don't forget to subscribe to the channel, hit that notification bell too so you don't miss our next deep dive. And remember, all those links for the books, the professional courses, the safe platforms we mentioned, they're all right there for you, conveniently located in the description. Your financial future awaits. Thanks for diving deep with us today.